It depends on your age. If you're a young person, like you're 20 years old, you got your savings from your first year's salary, you should probably bet the whole lot on just one thing, whatever you think is going to be hottest. But if you're 22 years old, I think you should have a minimum of your age minus 20, which is at least two investments. And if you're 30 years old, you should have a minimum, absolute minimum of 10 investments. So it depends on who you're talking to. So as you get older, almost everybody who's watching this should have a little bit of everything diversified and not bet the house on any one of these going up. So first of all, the exposure to precious metals should be modest. Most banks will tell you 3 to 5% is a good number. Not many going as high as 7 yet. I personally think that 15 to 22% is a good number, maybe 25. But once you get beyond that, you're in. The price of precious metals started to accelerate towards the half-year mark and carried on accelerating upwards since then. And across the world, those who follow precious metals started to raise their prices. So I think we probably started out at the start of 2025, hoping that we might see a 4,000, 4,500 gold price. Well, that came and went very quickly, and we went soaring through the $5,000 mark, which was seen as a ceiling by some, but it wasn't a ceiling at all. It went through the $5,000 mark like a hot knife through butter. Same thing happened to silver, where the top was originally seen at around $50, but it didn't stop there. It just kept going, and we ultimately reached a price of about $121, and gold reached about $5,600 nearly at the peak. As the rise accelerated, there were a lot of people who decided they needed to be on the fastest moving asset on the planet, which was gold or silver, depending on which way you were inclined. It was actually silver. So to do that, many people jumped on board the leverage platforms. These were platforms which offer contracts for difference, CFDs as they're known, or the futures exchanges, or of course they use different types of leverages through the shares or the ETFs or through options. Many of these people were trying to maximize their gains, so they were trading with effectively borrowed money. Now, if you go to a contracts for difference website, they typically allow you to trade 10 times the amount of money you've invested. So if you buy 1 ounce of silver, sorry, beg your pardon, if you have enough money for 1 ounce of silver, they'll let you buy 10 ounces, and you will owe them 90% of the money. But you've got this leverage trade. So if silver goes up by $1, you don't make the dollar you would have made if you just invested your own money. You make 10 times as much. You make $10. But that works in both directions when it goes down as well. Now, to protect themselves, these CFD sites always have what's called a stop loss or a limit, which means that if the price falls by a certain amount, below a certain price, which is calculated according to how much you own and how much other cash you've got in the account, they will automatically liquidate your position. That's called a stop loss. You may not know it's there, but it's always there. And that means that you might have bought silver at 100, but you can only afford to support that the silver as long as it stays above, let's say, 95. So the stop loss might be sitting at 95. The price goes below 95. Whether you like it or not, they will sell your silver for you through that stop loss. Now, the important thing to remember about a stop loss is you don't get the stop loss price. You might do, and usually you do, but more often than not, or sometimes, especially in a fast-moving market, you'll get the next trade. So the first time someone trades at 100, if your stop loss, let's say 95, first time it trades at 95, and your stop loss is at 95, you will get the next trade, which may be $94.99 or $94.90, depending on how fast the market is moving. In a very fast market, you might only get $94.50, but you're not getting the $95 stop loss. Likewise, when people are buying futures on COMEX, they might put in place a stop loss, or alternatively, COMEX would have a margin arrangement where if your holding, of the futures holding, falls below a certain level where you haven't got enough money to meet your commitment, you have to put up immediate margin. And if you don't put up immediate margin, which means putting in new money quickly, they'll automatically sell you out.
As prices surged, capital flooded in, not just from long-term investors, but from leveraged traders chasing momentum. Many used futures, ETFs, options, and contracts for difference, allowing them to control large positions with relatively little cash. Leverage magnified gains, but it also embedded hidden risk. Every leveraged trade carried an automatic liquidation threshold. When prices moved against them, positions would be closed instantly, often without warning. The rally built a fragile structure where enormous exposure rested on thin layers of margin and borrowed money.
So the whole, every commodity where there's a future will have people trading on leverage where they only need to put down a small part of the purchase price of what they bought. So what we had as the price started to accelerate upwards was more and more people jumping on board these leverage trades in every way they could. So some were buying the ETF, some were buying the silver on CFD sites, some were buying futures on the COMEX market. And all of them would have had some sort of stop loss, whether they chose to have it or the institution had to put it in place anyway. So you might have bought on a CFD site. The institution might have their stop loss at 95, but you might decide to put yours at 96, in which case yours would get executed and theirs would be cancelled automatically. But if you put it at 94s, theirs would be executed at 95 and yours would be cancelled automatically as it goes through 95. But these stop losses existed. So it's a bit like a forest where there's been a lot of dry weather and there's a lot of dry tinder in the forest. But it's not going to catch fire unless there is a spark. So the futures market, as it went up faster and faster, the silver price went up faster and faster, more and more people jumped on board buying these futures, buying the CFDs, all with stop losses, whether they liked it or not. And as the price rose, they raised their stop loss higher and higher to track the price of silver. Until one day, there's a spark. The first twig caught fire. And the twig which caught fire, which wasn't the cause of all the decline, but which was the cause of the first spark, was the announcement by President Trump that he's appointing Kevin Walsh as the new chairman of the Board of Governors of the Federal Reserve to take the place of Jerome Powell when Jerome retires as chairman in May 2026. That was, as far as market participants are concerned, a little bit of an unexpected decision. Well, they probably looked him up after he'd been appointed, and the first thing they learned was that back in 2011, he was seen as somebody who staunchly defended the independence of the Federal Reserve against government interference, which is, and we know that the Federal Reserve, Jerome Powell and other governors are under attack at the moment for not complying with the wishes of President Trump. So the fear was that President Trump was going to put in place a yes man who will do his bidding. And that was why a lot of people were using that as an excuse to buy precious metals, saying this is going to accelerate the end of the fiat system as we know it, because the debt's just going to keep rising. They're going to lower interest rates. The government will be forced into the market to buy bonds to finance ever larger deficits. And one day something's going to go wrong and the whole thing's going to go collapsing. I'll front run this future event by buying silver and gold.
The trigger came unexpectedly. President Trump's announcement that Kevin Walsh would replace Jerome Powell as Federal Reserve Chair rattled markets. Traders initially interpreted Walsh as a defender of monetary discipline rather than political influence. For investors betting on monetary collapse and runaway inflation, this challenged the narrative. Selling began quietly, but in a market packed with stop losses, it didn't stay quiet for long. Once prices dipped, automated liquidations fired in sequence, unleashing a chain reaction of forced selling across gold and silver markets.
But suddenly we got this appointment of somebody who, at first sight, people thought he's going to be a staunch defender rather than a yes man doing as he's told. And the result of that was some of those people who bought gold and silver on the grounds that the end is nigh suddenly thought, well, maybe the end's not quite as nigh as I thought. I'll sell and chase some other, something else which is moving. But of course, that selling immediately triggered some stop losses, which were quite close. And those stop losses caused the underlying position of those who held it to be sold, which pushed the price down, which triggered another stop loss. So we had this cascading stop losses, and each stop loss pushed the price lower, causing the next one lower to be triggered. So these stop losses were being triggered like a machine gun, bam, 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 each one pushing the price lower than the previous price, causing a cascade of selling like dominoes in a row, all falling over, knocking each other over. So that's what happened. And many of the people who were sold out on their stop losses didn't want to sell, didn't expect to sell, and don't want to be in cash. But they had no choice because they hadn't got the margin or the cash in the right place at the right time. What that means is, in all probability, the sell-off was overdone, based on the news. And of course, the other side of the coin is the appointment of Kevin Walsh really as, is he really such a hawk? Is he such a hard money man as people feared he was on day one? Well, you can look him up and read what he said, but here's what I think. I think Trump would only have appointed him if he expected him to do his bidding. So he may not turn out to be the staunch defender of the Federal Reserve's independence that people think he will be. He may not turn out to be the hard money man, the hawk that he's expecting people are thinking, but rather more of a dove, someone who's very much in favor of lowering interest rates. And people could go and look and see what he said about these sorts of things and draw their own conclusions. But my conclusion was he's more likely to be following the party in power rather than sticking to a dogmatic policy of no interference. But that's just my opinion. But by the by, it doesn't really matter what the truth is, because once that selling had been triggered, these stop losses, it was like a rat-a-tat-tat-tat-tat, each one pushing the price lower. I think we probably went, I don't know this, it's not investment advice, but I think we probably went too low, too fast on those 2 days when the market was collapsing. But what I can tell you from my studies of market collapses, stock market collapses, gold price collapses, silver prices collapses we've had in the past, and I studied what had happened in all the 5% declines. I had to go for 5% rather than 10 or 15 because there's not enough data with those larger declines. But at 5% declines, I've got hundreds of one-day 5% declines of different things like gold, silver, or stock market. And I find that on 2 out of 3 occasions, there's a strong recovery in the days, weeks, months, and year which follows. And as far as silver is concerned, on the 2 out of 3 occasions when it does continue upwards after the drop, it's up very, very sharply from before the drop. I think the average figure was about 38%. But we mustn't forget, 1 out of 3 occasions, it doesn't rise after a 5% drop, it continues falling. So, but the odds would have been, if you'd been bought every dip in history, you'd have been done extremely well historically if you'd bought the day of the crash historically.
What followed was mechanical, not emotional. Each stop-loss pushed prices lower, triggering the next. In fast markets, exits happened below expected levels, intensifying losses. Futures margins were breached, CFDs were liquidated, and leveraged ETFs unwound positions simultaneously. The decline fed on itself, collapsing prices faster than fundamentals could justify. Many traders didn't choose to sell, they were forced out. This was not a reassessment of value, but a technical breakdown driven by leverage, speed, and automated risk controls firing in rapid succession.
The biggest difference is the supply-demand equation. Back in 2011, there was a lot of surplus silver, and more silver was coming out of the mines than was being consumed by industrial use. For the last 4 or 5 years, industrial usage of silver has been exceeding mined supply. And the difference has been coming from the above ground stocks of silver. All these people who bought silver in the decade before, since 2011, hoping it would get back to $50, and so there was an awful lot of silver above ground, which has been recycled when it was needed, which started about 5 years ago when the mine production wasn't sufficient. The difference was met by dishoarding of hoarded silver, recycling, if you like. So what silver got recycled first? Well, it was the weakest holders, the ones who'd been waiting for years. They'd probably already got a slight profit. So as the price started to rise, some of those weakest holders, you could call them paper hands, if you like, the paper hands started to sell to supply the shortage in the market. And that shortage has continued year after year, and the differential between mine supply and industrial use has been getting bigger, industrial use exceeding mine supply. So more and more silver has to be recycled or dishoarded to meet that demand. And given that the weakest sellers have already sold out, that leaves people who are slightly stronger in terms of holding. So what that means is the price was starting to get squeezed higher to entice them to sell. And then, of course, we were at the point where the only holders left seemed to be diamond hands and the new speculators who'd come in the last few months, the ones who were buying the contracts for difference at the last minute. So the diamond hands weren't selling anyway, and the speculators were buying up all the silver on leverage. So there was no silver available, and the consumers of silver, the large factories, the industrial users, the solar panel manufacturers, the motor car manufacturers, the electronics industry, perhaps the defense industry, were more than likely saying, we can't rely on just-in-time delivery of silver anymore because it seems there might be some sort of shortage. Let's just get a little bit more stock. So they were accelerating their purchases, almost certainly. I've got no evidence of that, but I can't see they must have seen what was happening and said we can't take a risk that we have to stop our entire production line if we can't get the silver where we need it. So we had all these factors coming together, the drying up of the weak holders of silver, the new purchases by the speculators jumping in on the leverage contracts, and the industrial users starting to step up their purchases a bit because they were worried about shortages. So all of that was sort of coming together. Now, where are we after the crash? Well, not much has changed. Of course, we've probably had a drying up of the industrial users. They probably filled their boots with silver now. So that might mean we're in for a period, a little bit of the doldrums on the silver price. It will be volatile. It'll trade up sharply and down sharply, up sharply and down sharply. We might go below where we were, might go above where we were, but it's not going to go, I don't think we'll see a parabolic move to the upside like we saw before until the industrial use buying has settled down. But the fundamentals for silver and for gold has not changed. All the things we knew about before are still there. In other words, industrial demand still exceeds supply. The geopolitical situation hasn't got any better. Uncertainties around everything from tariffs to taxes to what's going on hasn't changed. The levels of government debt are not being addressed. They're reaching proportions which we know will be they are already unsustainable. So it's only a question of time before something goes wrong somewhere in the world. Could be in Japan, for example. But at one point, we could have a complete meltdown in government bonds because the only solution left to pay that debt is an inflationary solution. So we go into an inflationary environment, we then have a meltdown in bonds, then the central banks step in and buy the bonds to stop them falling any further, and then we have massive monetary money coming to the system, which will then drive asset prices upwards. So all of that is still in place, and of course it could then lead to some sort of global currency reset, where basically the currencies we have today are replaced by something new, and you can't change all of your old money into the new one. That is a possibility, which would be a way of governments avoiding default. They basically say you have to use our new currency, the central bank digital currency, but you can't change your old dollars into the new one beyond a certain point or according to certain rules. So all of these things are what are still in place. Nothing has changed, and one of the reasons people were accelerating their buying of gold and silver was they were front running this future event, which you don't know when it's going to happen. You don't know how it's going to happen. You don't know what shape or form it's going to take. It could be high inflation. It could be a bail-in. It could be restrictions. It could be capital controls. It could be a new currency. There's lots of possibilities out there. What we do know is the present situation of ever-increasing debt is unsustainable. So something will happen at some point. So people are now starting to front-run that. They're not going to change their minds. They're still going to be front-running it. It's just a question of how long it takes for those buyers to come back in the market. And this is my opinion. It's not a guarantee that it's going to turn out that way, but I think in my opinion, the buyers are still there and will still be looking to buy it. And from what I hear, at least here in Europe, I can't speak for America, where I think the situation might be slightly different, but here in Europe, I spoke with one of the largest coin dealers yesterday, who I'm a very good client of theirs. I'm in there all the time. They are currently 100% out of silver. They have been for weeks. They can't get any new deliveries. They've got silver coming in the door from sellers, but it gets sold out the very moment it comes in. As soon as it comes in, the next guy at the door buys it off them. They've got no gold coins, no small bars, and the only gold they've got are the 250 gram bars, the 500 gram bars, and the 1 kilogram bars now. So all the small stuff, all the silver's gone, and all the small gold is gone.
Despite the crash, the underlying supply picture remains tight. For years, industrial demand for silver, from solar panels, electric vehicles, electronics, and defense, has exceeded mine production. The shortfall has been met by recycling and above-ground inventories, much of which has already been exhausted. Weak holders sold earlier in the cycle. What remains are long-term holders and strategic users. Even after the sell-off, physical shortages persist. Reports from major European dealers confirm limited availability, with silver selling the moment it arrives.
It depends on your age. If you're a young person, like you're 20 years old, you got your savings from your first year's salary, you should probably bet the whole lot on just one thing, whatever you think is going to be hottest. But if you're 22 years old, I think you should have a minimum of your age minus 20, which is at least 2 investments. And if you're 30 years old, you should have a minimum, absolute minimum of 10 investments. So it depends on who you're talking to. So as you get older, almost everybody who's watching this should have a little bit of everything diversified and not bet the house on any one of these going up. So first of all, the exposure to precious metals should be modest. Most banks will tell you 3 to 5% is a good number. Not many going as high as 7 yet. I personally think that 15 to 22% is a good number, maybe 25. But once you get beyond that, you're in very dangerous territory. And when I say, and I don't mean that 25 is not dangerous. 25 is an extreme amount, but I am very bullish on the entire sector, and that does include direct precious metals, physical, through the ETFs and through the derivatives, including mining stocks. So the whole host of things. And of course, some of the mining stocks aren't just mining gold and silver; they're mining other things as well, like copper or other metals ending in IUM. So I like to be very, very diversified because I'm older than young people. Young people can certainly, if they have a view on one metal, they can bet the whole lot. But when I say young, I'm talking about somebody who's perhaps been earning money for 1 year, has got another 64 years or 44 years of earning ahead of him. So if he loses it all, he can get it back.
Short-term volatility is likely. Prices may swing sharply as markets digest excess speculation and industrial buyers pause. But the bigger picture remains unchanged. Global debt continues to rise, geopolitical risk remains unresolved, and inflationary solutions loom as governments struggle with bond markets. Whether through monetary expansion, currency restructuring, or financial repression, systemic pressure is building. Investors are still front-running an uncertain future. The recent collapse may have gone too far, too fast, and history suggests such episodes often mark resets, not endings.